They are talking about $700 billion worth of IPOs coming this year. And if that is the case, this will be the strongest IPO market since 2000. And the problem with these IPOs is that they better have some strong, solid underlying earnings. So a company that was valued at $20 billion, they raised about $2 billion, selling at 5+ times their revenues, no earnings, losing about $900 million a year, more than double what they lost the year before. Even though they increased their market share to 39% because they have a cute strategy, they call it the anti-Uber strategy, social consciousness strategy. So even though they have a cute message, cute doesn't make it profitable. These guys are valued at 5 times the revenues. They want to value Uber at 10 times the revenues, and they're about to come to market in a few months from now. And that will be a valuation of about $100 billion. All in all, I think the IPO market, for that to be a success, companies with underlying earnings, or at least a strategy to show us earnings in the near future, has to be a part of it. Otherwise, it's just going to suck out a lot of demand, money that could have been going to stocks, good, solid companies, and nothing good is going to come out of it. We already know what happened back in 2000 when we got all these Y2K IPOs, companies that came to market like mushrooms, one after the other, with no underlying business even. I'm not saying Lyft doesn't have an underlying business, because they do. What I am saying is that these valuations are, I think, way, way, way up there, and it doesn't make me comfortable. And that said, that brings me to where we are at in the economic cycle. We all know that the yield curve inverted. That cannot be, in general, a good sign, because an inverted yield curve was an indicator for a recession in the past 60 years or so. What we are really looking for is an inversion between the 2-year and the 10-year. And last week we got an inversion between the 2 months money market and the 10-year. Not by a lot, I think by about 5 basis points. The good news this morning is that the 10-year Treasury moved up 25 basis points so far. Understanding that we are in some sort of a slowdown coming from China, from Europe, from Japan, and some sort of a slowdown in the US, because our GDP numbers are not anymore growing at 4% like they did in the third quarter of last year. Now we are growing anywhere between 2.2%, 2.5%. But that slowdown brings down interest rates in general. And interest rates are extremely low nowadays. Individuals, countries are locking money for the next 10 years at about 2.45. This is pretty low, which means we need to start looking at some dividend yielding stocks, because that is one good way, if we can find decent companies that have very strong dividend yield coverage. It's a way for us to be able to generate some cash flow and hopefully some growth by buying good companies that can grow their share price. One company that comes to mind is AT&T. AT&T at this point pays 6.6% dividend. That dividend is covered pretty strongly with their cash flow. The cash flow of this company, as we speak, is $28 billion a year. The dividend that they pay, the 6.6%, costs the company about $14 billion. So that dividend is covered almost 2 times with the company's existing free cash flow. Not only that, the expected earnings per share for 2019 is about $3.59, which means AT&T is selling less than 9 times earnings, as opposed to the market that sells at 17 times earnings. The negatives are they spent about $180 billion recently buying 2 large companies, Time Warner and DirecTV. And that is a negative because at this point, AT&T's outstanding debt is just about $180 billion, which makes that company the largest indebted company in the world. This year alone, they're going to be paying about $2 billion of that debt. Next year, they're going to pay another $20 billion of that debt. And if that is the case, we are definitely going to start looking at companies like AT&T that might grow the share price because they are just selling at very attractive valuations. And for the time we are waiting for that stock appreciation, God willing, to happen, we're going to collect, if possible, 6.6% in dividends.
In some regards, Apple has been kind of disappointing to watch because they are struggling to figure out what their next big product is going to be, even though they have a lot of things on the drawing board. This latest move into increased content and subscription services, reports that I have written have said that they took a very timid approach to it, and it's kind of like a wait and see. They'll probably do okay with it, but we're not going to see anything like the growths that happened in the past, because what they're predicting is that their phone sales are going to be decreasing in double digits. So, because they're waiting for this next technology to come along. And quite honestly, a 5G phone, I don't think that we're going to see 5G phones that are of any consequence for 2 years, even though chips might be there, the technology to implement. And then there was another problem brought up, that all of the infrastructure that's been put in place. I remember when they came out with 3G, going to 4G, and I kept looking at my phone and all I saw was 3G coming up 2 years later, because it takes that long to put everything in place. So it might be a 4 or 5 year cycle before that really gets any kind of footing.
I've been following Apple in these events for some time now, and this was an event like no other. Even if some of the revelations were timid, it was the first of its kind for Apple. Usually they are either software specific or product specific. This is the first services based announcement, and it was at the Steve Jobs Theater, so that is notable because they don't hold all their events there. So they also announced the Apple Card. Again, this is not much detail on what this is, but we do know that the issuing bank is Goldman Sachs, and that MasterCard is the payment network. So they do have big names behind them, that it's something substantial. And then the most anticipated was Apple TV Plus. This is what we know the least about, but very promising. A lot of people thought it would shape up into something different, maybe a competitor DirecTV Now or Hulu or one of those, but it seems to be more of a competitor against Netflix. Okay, it's all original content, but the big surprise is they really have some big names behind it. Oprah, Steven Spielberg. We don't know the pricing model or anything, but I think there'll be more to come.
And Apple is one of the richest companies in the world, $130 billion in cash. They are spending on content, I think, about $2 billion. But by comparison, Netflix spends north of $10 billion. And Netflix has a menu of about, I think, 900 plus original shows. And Apple will have an uphill battle here to climb to be able to start getting a decent slice out of this market. The good news is that, like Joe says, that presentation they had is another stamp of approval that they are most likely on their way to shift the business model more so to services, which is a very high margin business.
The 2 year to the 10 year being the main indicator that we want to look for had consistently been about 16 to 17 basis points for the first couple of months of the year. That has flattened a bit. It's down to 14 basis points. All of these inversions, the data that I've seen, the lag between inversion and recession has averaged anywhere from 6 to 18 months. So although it's not a time to hit a panic button, it certainly is something that we need to keep an eye out for. But that 2 year to the 10 year is staying pretty sizable at 14 basis points.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. If you like the content, please become a subscriber to our YouTube channel. You can always reach us at our main offices in Woodland Hills at 818-914-7461. The highlight of the week is that bull markets, more often than not, climb a wall of worry. The recent worries just got accelerated. Markets around the world are facing a global slowdown, pending Chinese trade negotiations, inverted yield curve. It is our job to look for investments that pay constant cash flow that for the time we are sitting and waiting for these companies to appreciate in value, we can at least collect day in and day out dividend payments.